All right, so I'm back to this slide, which I discussed before the break. And in our previous conversation, what we found was that the company which is levered is able to generate 20 units of resources more than what an unlevered company can. And this 27.20 was an answer that what Modigliani and Miller said is not true. Because if Modigliani and Miller were true, there should have been same amount of values on both sides. But here you see that the one side value is 660 and the other side is 687.20. I can use the cursor. So if Modigliani and Miller were true, these two totals should have been same. But the fact is that this side is bigger than this side by this. It speaks about the non-proving of Modigliani-Miller's theorem. I want to take you further from this discussion now, which actually relates to your one of the tasks, maybe the last task, is that imagine that this 27.20 goes forever. This is 1 year situation, yeah? Just imagine a situation that the company which is levered will generate, let's assume that the other situation will remain same, nothing will change. And this company which is levered would generate $27.20 or $1 million, whatever, extra than the unlevered company for the rest of the life. Then this 27.20, I can call it as a word perpetuity. Okay, we use two phrases, annuity and perpetuity in finance. Annuity is that if you give loan to somebody, let's say 10,000 euros at 8% for 10 years. So you know that every year you would be getting 8% on 10,000 would be 800 euros coming to you for 10 years, but this will not come endlessly. It will stop coming at some stage. This is called annuity. Annuity. What happens to this? But if it happens that this is like a pension, it will come for the rest of your life, then this becomes perpetuity. Perpetuity comes from the word perpetual, forever. Okay, so that's why this is called perpetuity. So let's assume that things would never change and this 27.20 advantage the levered company would have for the rest of its life. Then this will be for endless periods. In finance, we believe in the future. What we also want to calculate the future values today. So basically, we want to find out the present value of the future. Do you get my point? So we want to find the present value of this perpetuity. Okay. In this case, the formula of perpetuity is that the income stream you get or pay divide by the rate of discount. And in this case, the rate of discount would be the rate of interest, which is how much? 8%. So I'm writing in because I'm writing in decimals, basically 8%. Because the 8% is the rate of interest, yeah? So 27.20 divided by 8% is 340. It means that if in 1 year a company which has levered is 27.20 million richer than its unlevered counterpart, all else being same. And let's imagine that this edge, this advantage of 27.20 would remain forever. Then become perpetuity. And let's imagine that the rate of interest would remain 8% forever, which is a very heroic assumption. Okay, in that case, I divide 27.20. It means that today I can say that if I compare levered and unlevered company, I can say that for the rest of the life, altogether, the levered company would be richer than the unlevered company by 340 million. Okay, and this, how do I do this calculation? I get this calculation by the simple formula of, in finance, especially this formula is used by the actuarial sciences. You know actuarial sciences? When you have, when you pay the insurance premium and the pension companies, they want to see, okay, what age you retire? Okay, 65. What was your last drawn salary? Maybe 8,000 euros. And how likely you will be alive for next 20 years after retirement. And then they find out that how much is the pension you would be getting. Okay, so this is the perpetuity. But why we use perpetuity? Because they assume that you would remain alive for the pension you get for basically indefinite period. I mean, you can be alive after 40 years, even 50 years also. So that's why this formula we use more in case of the actuarial sciences. Anyways, that's the different point. This is 340 million, yeah? But before I go to this point, I want to introduce you to two new phrases. Do you believe that 27.20 occurred only in 1 year? I mean, this calculation is based on this calculation, yeah? This was based on one calculation. This 27.20 is called, I want to add these new words for you. It's called, this is called interest tax shield. Okay? And when this interest tax shield is assumed to be forever, and we assume it to be a perpetuity, then this becomes debt tax shield. It becomes debt tax shield. Okay? Make sense? Yeah, so these are the two new phrases. Yes?
Going back to the Annuity. I watched this Annuity, and then the actual came out with like an opposite of the Annuity, which in that case they call it an income program for the pensioners. Whereby with an Annuity, of course, you give the company money, and then they pay your pension for the rest of your life, based on the calculations, gender, and all that. But then they had income program, which meant you still give the money, you deposit the money rather with them, but then it's like you're drawing out of that fund, and it had a time limit of say 10 or 15 years, and your interest rate was market rate, with just a minimum interest return. So that was kind of watching a little bit of how the Annuity, because after 10 years, they would calculate how much you have.
When you get a job at the age of 30 or 25, your employer knows that you would be retiring at 65. So it's a 40-year fixed period, definite period. Okay? The length of the period doesn't matter, but it's a definite period. So your contribution to the pension fund is an annuity. But when you retire, then comes the concept of perpetuity, because it's not definite how long you will remain alive. There are some pension funds which give you pension for a certain definite period, even the post-retirement. There are some pension funds which say that we give you only pension for certain time period, but usual pension phenomena in the public sector or elsewhere is that you get the pension for the rest of your life till death comes. So see, you could have worked for 40 years and you could have alive only after 10, 15 years after retirement. But that's sort of, but there is an element of indefiniteness.
It's not a decline. So, they have had that as an option for the retirees, so that if a client says, I want to draw down, because on the drawdown, they got more money.
Yeah. Many people operate like this.
Then they can do that. But then the ones who are more risk averse go for the perpetual annuity, where they know it's guaranteed until
Yeah.
But then it's also on the other side, if, for example, you deposited the money with the company, and after 1 month, the client passes on. Then the company benefits because they're left with all the money.
That's true.
And they only paid once.
Yeah, you're right. I mean, many people say that, hey, you have been managing our fund for many years, 40 years. It was a legal mandatory requirement. I have to use my pension scheme. But now I'm retired, I'm free bird, give my money, let me spend the way I want it. So that's why many people don't do it. So the idea is not about the pension, the idea is that we borrow this formula from the pension sciences or the actuarial sciences. So that gives us some present value of the future income stream. So the present value of this lifelong benefit which the levered company has over the unlevered company is 340 million. And this 340 million, if you see it, you can also say that this is 34% of 1,000 debt with this 1,000. So you can say that this is 34% of this 1,000. So 34% was tax, I can call it T subscript C, corporate tax, times D, which is debt. So it means that if you want to make a formula out of it, it will be equal to, can I try this? Maybe it works. So it will be so your total debt tax shield, is equal to corporate tax rate times total debt. So this is called debt tax shield. Yep, it's fine. Because 27.20, when you divide by 0.08, it comes to be 340, and 340 can also be calculated by multiplying 34% with 1,000. And 34% is, in this example, we assume as a corporate tax rate, and 1,000 is your total amount of debt. All right, so I want to show you something else now. Actually, I should show you the file which we have in spreadsheet. So if you go to spreadsheets, there is a file called MNS Debt Tax Shield. Yeah, can you see here? That's why I chose Marks and Spencer for the example as well. So if you open this sheet, this Excel, sorry. Oh yeah, this. Okay, let me check if I can show it. Yes, I can. Okay, so here you see debt tax shield of Marks and Spencer. I think I calculated it in the last semester, so this is 2017 or 18 data, but we can double check. The interest payments of Marks and Spencer that year or that period was 113.8 million pounds. And the interest rate was 6.36. How do I knew it? You see what? You have to be very careful about this rate. You see, if you type in corporate tax rate Britain, it can come out 19%, 20%. I don't know which number it comes from, but that's not what we needed. We want to see the effective corporate tax rate. So I think I should be very careful. It is not EC, it's not corporate tax rate, it's effective. Effective means what matters to the company, what is based on the company's calculations. So TC is the effective corporate tax rate. And how do we calculate it? It's not a big deal. Look, you have the profit before tax, yeah? Look, now I repeat, and I will tell you which information come from which source. The interest payments come from the income statement. It's a finance cost. The profit before tax come from the income statement. It's your gross profit. And then it shows how much amount of tax you pay. Okay, make sense? And you calculate your tax rate. Sorry, I think I said something else. The tax rate comes to be 21 point. So if your profit is 580 something and you pay 125 as the tax, it means that your tax rate is the amount of tax you pay divided by profit before tax. So when you divide the amount of tax you pay by the profit before tax, that calculates the tax rate. I'm sorry, I was confusing it with interest rate. Okay, make sense? Are you all happy? Okay, good. So I can say that the tax rate is 21.58%. Then I saw that the short-term borrowings mean the current borrowings of Marks and Spencer was 125.6, and the long-term borrowings of Marks and Spencer was this. The total borrowings are this. And this data you get from the balance sheet on the liability side. All right. And then this data, the interest payment which you make, come from the income statement. And then what I do here, I divide G4. Who is G4? G4 is the interest payment, and G13 is the total debt. Total debt, and that is at the base, at the denominator, and the numerator would be the interest payment. For example, if I say that, hey, you have borrowing $1,000 and you pay 200 as interest, what is your interest rate? You say 200 divided by 1,000, 20%. Make sense? So that's what we calculate. So it comes to be 6.336. Okay. Now, the book said that the interest tax shield is equal to the corporate tax rate divided by the interest payments. Remember in the last example, this amount, 27.20, do you know where it comes from? it is basically 8% of what? It was 8% of it was it was 8% of 340. And 340 was your I'm just sorry. Just,
2720 was 34% of the interest paid.
34% of the interest paid. So it was sorry. So 27. It was 34% of interest.
Yeah.
So it means that it was 34% of 80. Yeah.
Yeah.
So can I say that it was TC divided by interest? Okay. So that is the interest tax shield, and then so it's interest payments divided by tax rate you pay. Remember, this advantage was only to the L company, levered company, which pay interest. So this was tax rate, which is 21.58%, multiplied by the interest payments, which is 113.8 million pounds. And this gives us 24.56 million pounds. This is a 1 year saving. Look, this is the amount which Marks and Spencer has by virtue of being the levered company. So I can, the corollary, the counter statement is that if Marks and Spencer had no debt, this 24.56 million, which it has, would be absent. So this 24.56 million pounds, Marks and Spencer earned not from the asset side, from the liability side. And if we assume that Marks and Spencer would earn it forever, like a perpetuity, the same argument. And let's assume that the interest rate would never change. It would always remain something around, where is it? Yeah, around 6.36%. Then I can calculate the debt tax shield. So for the lifetime from now onwards, if imagine this data is today's, the current, then nothing changes, all else being equal. I can say that Marks and Spencer has added 387 million pounds to it by the virtue of being a levered company. This is the additional value. This is the present value of the future tax interest shield, which become debt tax shield if you make it forever. Okay? This is your debt tax shield. This is the money which you save as a corporate finance manager of the company by borrowing. And if you don't borrow it, then you will not have it. Yeah. So it means that all you need is for this task, which is your task 7, I guess, all you need is to get this data, and this data is very much obtainable from income statement, except for this data. This is just a total. So only this data come from the liability side in the balance sheet, but rest all the data is in the income statement, basically. So it's quite doable. Tatiana, yeah? How about you, Alexandra? Will you do it? Right.
Yeah.
And this will give us your next task. I've explained it already, so I will not go into it because I explained it. So take a real life scenario. Choose a levered company. Okay, so you pick up a company for this task. And I said choose a levered company, right? As a matter of fact, you don't have to search for any levered company because mostly all the companies are levered anyways. Which company has zero debt? Assume that all the debt is equity. So just by force make it unlevered company. Do you get my point? You assume that the company has no debt and whatever is debt is also equity. Okay, so call it, assume it as an unlevered company. And then based on this, calculate the present value of debt tax shield over a period of 3 years. So do this calculation for 3 years. So do this calculation, for example, when I say 3 years, it's very important that you take this data for 3 different years. Okay? So look, this is your forecasted value, right? This is your forecast for the rest of the life. So each year this forecast would change. Because each year your interest tax shield would be different. Does it make sense? So basically what I'm asking you, have the same company, but do this calculation for 3 different years. So let's say you take Nokia, you take 2018, I think 2018 data is available now. For some even 19, well no, 19 is in frozen, 18 is available for sure. So 18, 17, 16. So basically do this task 3 times. Keep the same company, but do it 3 times, 3 years. And then forecast your debt tax shield. Remember this debt tax shield thingy is a forecasted value. But this is forecasting, not a fluke. It's not something you just say it. It's not that you just pick a chit, ask a parrot to come and pick up a chit. No, it's based on your informed, sophisticated calculations. All right. Are we missing something? We are missing something. We have only seen the goody things of debt. We haven't seen the bad things yet. And the bad things are financial distress cost. Because if you are allured, if you get tempted, if you get too much swayed by this alluring couple of extra millions for each year and for the rest of the life, you could be, the danger is that you can be converting your equity to the debt. And then we are inviting the company's death prematurely, because then comes that you have to not only have to pay the interest, but you also have to return the money back to the debt holder. So you come under unwanted, unnecessary performance zone, whereas you have the luxury not to be in when you are having more equity than debt. Okay, and that can prepone the bankruptcy of the company. Okay, whereas if you go by equity, you don't get bankrupt, but if you're borrowing too much, then you can be in trouble. So the financial distress cost. So be careful. Your discussion will be incomplete, even when you are making a presentation based on this task. Don't just glorify the debt tax shield, but also write in the comments that that we need to be careful of the flip side of the over leveraging company, that we can invite financial distress cost here. So debt capacity is something which you can discuss. Each company has different debt capacity. We try to investigate in our research, as I showed you before. Debt capacity is a very dynamic phenomena. It comes and goes and changes. As a rule of thumb, the companies which has more tangible assets than intangible assets has a better debt capacity, because you can use the tangible assets as a collateral to get the borrowing. right? Whereas it's more difficult to get loan by depositing or pledging your intangible assets. Okay, are you with me? So it means that a company like BP is a better borrower than Microsoft, all else being equal. Okay. The second factor which can affect your debt capacity is that longevity, how long you have been in the market. When you have a longer tenure in the company, that is a vindication, or that's a reflection. That's a kind of proof, evidence that, hey, I have stood by many ups and downs in my life. So because I survive, it means that I'm capable of having more debt. Do you get my point? Whereas the new companies, the startups, find very difficult to get debt because there's no historical track record of their performance. The third reason you can give the debt capacity is that the company which has lower operational cost is capable of borrowing more. So I would say this housing company called Coas is a great borrower because most of the assets are tangible assets. And secondly, their operational cost is very less. 1 or 2 janitors, they can manage the entire apartments. But so the operational cost is very low. And if you see that in the main office in Keskusta, there are very few people who are dealing with, and mostly the dealing is online, so you don't have to be physically present there. So so the operational cost is quite good. So based on these two bases, I reckon Coas is a very good, should have a very high debt capacity. And there are some more reasons for it. So these are the 3-4 main prominent reasons which can have an effect on your debt capacity, right? It's a dynamic concept. And just for your information that you can also, you should know how to calculate the weighted average cost of capital as well. If you have 60% equity and 40% debt, then this will be 0.60. Yeah. Take an example. You have borrowed. You own a company. You are a CFO of a company. 60% is equity, 40% is debt. The share of equity is 0.60. The share of debt is 0.40. RE, the cost of equity you pay, right? And how do you get the cost of equity? You use CAPM to calculate the minimum cost of equity. And this is the cost of debt, RD. And this you know by yourself. How do you know it? Well, divide interest by total debt. Remember in the Excel, we did the interest payment divided by total debt is cost of debt. But your actual cost of debt is lower than what seems to be because your debt is also subsidized. That's why I multiply here. I insert this term 1 minus TC because your interest is tax exempted. Now, let me do some calculation here. And I can do with the help of Excel. I can do it here. Let's say the debt share is, let's say a company borrows 40% as debt, and equity share or equity is 60%. Yeah. And the cost of debt or the interest, let's say the interest rate interest rate is, let me see if I can, it's visible, yeah. The interest rate is, let's call it 0.5%, 5%, let's say. And the equity is 8%. And taxes, or the corporate tax rather, the corporate tax is let's say 34%, 0.34. Then your weighted average cost of capital will be equal to your debt cost of equity, share of equity times the equity cost. I use the bracket so that they don't mix up. And then I plus here. And then I take another bracket, which means the debt share is 40% times interest rate. Okay. I'm doing it on purpose, actually. I'm doing it on purpose. So you've seen that your weighted average cost of capital is 6.8%, but it's not, because remember that you are exempted to pay tax on interest. Then that exemption also applies on the percentage of interest as well. So what we do here, we make one more bracket, and we call it 1 minus TC, the tax rate, and the bracket closes, and the sign of multiplication. That comes to be 6.12. So basically your cost becomes, earlier it was something 6.8, yeah, when we didn't consider tax, but now it comes to be 6.12%. So actually I can change it to percentage. Yeah, we get 6.12%. So this is the weighted average cost of capital. So now, after knowing the tax shield and debt tax shield and all these concepts, that interest is tax exempted, Modigliani, Miller, everything, you have all the data, which is not a rocket science to get. And you have done in the previous task, remember in the task 2 and 3, you have done CAPM. In Jensen Alpha, you used CAPM, yeah? That's your cost of equity also. Cost of debt, you can calculate. Cost of equity, you have. Tax rates, you can get. The tax paid divided by profit before tax. So everything you can obtain. And then you put all those numbers together, and you can find out how much is the cost of, how much the weighted average cost of capital. Yeah. If you are an unlevered company, the only cost of capital is cost of equity, because there's no debt. But if you are a levered company, which mostly companies are, then you have to account for this formulation. Yeah, make sense? So this is your formulation of D3, G3, D2, G2, but in between comes 1 minus tax rate. So basically, if your interest cost is 5%, right? If your interest cost is 5%, then 1 minus tax is 0.66. It means that basically you are only paying 66% of 5%. Does it make sense? 5% is your face value of interest rate. But actually, you're not paying 5%. You're paying only 66% of 5%. Sounds good? Or not? You want to go home? What if I lock the door?
Then we'll use the word.